You want to have money in retirement accounts. This is level 3, asset protection. This is the final episode.
You may think you're above it. You wanted to go straight to the advanced, level 3.
There's $35 trillion in retirement accounts in the U.S.
Think, how do I protect my IRA or my 401k from this deal? Welcome, everybody, to this week's episode of the Main Street Business Podcast with yours truly, Mark Kohler, and the amazing Matt Sorensen. That's your cue.
Yeah, baby. That's my cue. This is level 3, asset protection. This is the final episode, the asset protection series. We're going to get into it fast here today. Go through the last items we think you need to know. This is advanced, level 3. All right, well, let's jump in. You want to let's go retirement accounts.
Right out of the gate.
You know what I want to start with.
Yeah.
There's $35 trillion in retirement accounts in the U.S. We want to make sure you get to keep yours.
Yeah. And a lot of people think, how do I protect my IRA or my 401k from this deal? I need an LLC to protect my retirement account or need this. Well, there's a little known person in this realm of planning known as O.J. Simpson. So, Matt, do you want to tell us how retirement accounts are really asset protected so that people have the truth?
I think the first thing, just conceptually, if you didn't know about asset protection on retirement accounts, know this. That is one of the best places to have your money and your wealth built if you're going to get sued. You want to have money in retirement accounts. There's a whole set of laws designed to prevent creditors from getting your retirement account, even if you leave the scene with a bloody glove and you get a judgment against you from the Goldman family for $30 million.
That's right. Even if hypothetically you're on I-5 like Grand Theft Auto in a white Bronco with helicopters around you.
Yeah, and someone's chasing you down, your retirement account's going to be okay.
Yeah. OJ could have just been out the window. It's all right. My $3 million NFL retirement is just fine. And it was. That's the crazy part. So people, it sounds like a basic, but it really is advanced in the sense that you want to be thinking about that wealth building going on and how your IRA is treated, how your 401k is treated. And so really, this is spoiler alert. There's nothing you need to do. Your IRA and 401k is protected. Now, the only two people can get it. Number one, the IRS. If you screw over the IRS, they're going to get into your retirement account. And I'll go number 3. But number 1 is the IRS. Number 2 is a spouse in a divorce. In almost every case, you're going to see a bifurcation of retirement accounts, or at least they're going to be in the discussion in the settlement. You know, one spouse may get them while they give up something else. But they've got a spouse in a marriage without a prenup or a post-nup is going to have a right to that retirement account. Some of you are like, well, was retirement before we got married? Well, it depends on what state you're in and what type of commingling took place. All sorts of things could happen. The third person that can get into your retirement account or entity is the U.S. government in some sort of criminal case. You know, if you've been criminally prosecuted for fraud, whether it's the SEC or it could be ATF or, I don't know if you're running drugs or whatever you're doing. Your retirement account's going to go away quick. So the feds can get your retirement account, the IRS, and a spouse. Equally, all three very dangerous. So make sure you're careful there.
Yeah, and the one distinction on retirement accounts, keep in mind, 401ks or pension plans, they're called ERISA-based plans. Those get a pretty much blanket protection. A creditor's not going to be able to get them. That's what OJ had. He had an NFL pension, basically a 401k, that's more of a pension plan. But even though he had like a $30 million judgment against him because he was found liable civilly, not guilty criminally, they couldn't attach that. IRAs are a little different in some states. IRAs are state-specific, and you guessed it, some of the states that are a little quirky where your IRA could be at risk, California. Yeah. California says your IRA is protected from creditors up to the amount that it's necessary, the money in there is necessary for the use of the dependents. So if you have a $50 million of assets and you have a $1 million IRA and they're trying to get at that $1 million IRA for whatever reason, why would they go after your other assets? But let's just stick with me. That IRA could be at risk because it may not be necessary for you, the person dependent on it in retirement, or maybe you have a spouse or other people dependent on that money that could be in the IRA. So it's a little quirky in California and some other states, but generally IRAs are still protected. Very rare a creditor's going to be able to get at even at your IRA.
Now, as we go to level 3, Matt and I were trying to think of, are we just going to throw a modge podge of strategies? Which one's the most common? Which one's the most affordable? Which one's more people need but don't use? And what we thought was, let's go to what I think many of you are going to feel is your number one asset, and that's the equity in your home. How do you protect the equity in your home? Believe it or not, we're talking advanced strategies when we get to the equity in your home.
Yeah.
Because there's only a few states, and I've got them here in my calendar, got it here in my book, the Tax and Legal Playbook. Both of these desktop references, so important. But the Tax and Legal Playbook, there's a table in the back that points out some states say, you know what, that equity in a person's home is so important, we're never going to let anyone in a lawsuit touch it. If you're in one of those states, that's your first line of defense. You're going to be like, oh, sweet. Now, believe it or not, we go back to OJ. I mean, the guy was a genius. He had sold his home in California in this process and bought a home in Florida during the criminal lawsuit. And little beknownst to the Florida state legislature, they were going to get brutalized with media going, how did you let this guy hide his home in Florida? And they're like, whoa, we didn't have a rule that you can't do this when you're... Anyway, so the point was Florida has some rules that if you're under a pending action now, it's going to be a little harder to hide your money and equity in a home. But for the most part, you have a home, and let me read the states. Matt, should I read them off real quick? Should we just throw it out?
Yeah, we've got the homestead exemption is awesome. I was going to say even Florida, which has this unlimited homestead exemption, where you have a $10 million home and you got all that equity in it. Someone's got a judgment. They ain't able to get that. But also remember the MCI WorldCom frauds and then Enron.
Yeah.
All those executives, they also went to Florida, and they bought these big old mansions. They knew they had lawsuits coming down the pipe from investors and people that lost money. So Florida's been a haven for some of those people.
Yeah. Now here's
not just the cartels, and money launderers.
Yeah, here's the states. If you call it District Columbia. District of Columbia is unlimited. Florida, unlimited protection. Iowa, Kansas. There's some big states like Massachusetts has 500,000 protected, Nevada 550. But anyway, the unlimited, continue with that. Oklahoma is unlimited, South Dakota unlimited, Texas unlimited. If I said read you those states there, those are states where your equity in your home cannot be attacked in a lawsuit. And then it goes down to some states, Pennsylvania, no protection. Pittsburgh, if you're in Pittsburgh with a big home in the subs, no protection at all. Kentucky, $10,000. But it does include a house up on blocks and a Trans Am out front. So
it includes the Trans Am.
It does include a mobile home.
Whether it's working or non-working.
Yes.
Still protected. Creditors cannot get it.
Arkansas, it does include a double wide, but not a single wide. So I want to throw that out. I'm making enemies everywhere. Seriously, Arkansas, the homestead exemption is $2,500.
Yeah.
Hell. So anyway.
Now see, let me back up as you're saying this is where we talked about, remember level 1, asset protection is not like the suit you buy off the rack. It's tailored to you. If you're in some of those first states Mark was just rattling off about unlimited, stop right there. You're done. But also, maybe you're in Texas and you're like, I heard Texas unlimited. Well, what do you need to do in Texas? Don't you need to file a homestead declaration or a declaration of homestead? Some states you have to claim this to get this with the county or whatever. There's actually a filing for it. Most states you don't, actually, which is nice. You don't have to do anything. It's just, is it really your home or not, where you reside? So this is not a second home type thing. Just so you guys know, this is your principal residence where you reside. Yeah. But that's why this is tailor-made. And if you got a ton of equity in your home, get Mark's book, for crying out loud, if you don't have it already. It's got the guide, or obviously you can talk to one of the attorneys. We can help you kind of narrow this down too.
Yeah, I love it. And Matt's point, Iowa and Kansas is not automatic. You've got to file something. But Texas and Oklahoma are automatic. So again, you've got to know the rules in your state. And these rules can change on a dime. I put that as an asterisk at the end of my table in my book because one legislative bill and the state rules change. So you always want to use mine as a starting point. Okay, now, before we get to I've got a whole chapter in my book on how to protect your home in a lawsuit. Number 1, find out what your homestead exemption is. Number 2, which is a cheap, affordable way to go, is tenancy by the entirety. Tenancy by the entirety. Now, what that means is this entirety concept is that if you're married, we're going to look at your home equity in a different way because as an entirety, you're tenants. That's kind of where that word came from. That it's not fair that if your spouse goes out and they're a criminal or stupid or getting a lawsuit and they're texting and driving and that husband or wife gets in a lawsuit, can the innocent spouse lose the equity in the home because of that spouse that made a poor decision? Well, in some states, They don't want that to happen. And so they have these this is tenancy by the entirety. This table's there's more states that provide some of this. It's called full bar protection jurisdiction. So that no matter what that other spouse does, your home's protected even after a divorce or the death.
Yeah.
So that, when that guy dies, well, then we'll go after the wife's home. Nope, full bar. So this is interesting. Just some of the states that have this is Indiana, Hawaii, Pennsylvania. So, where Pennsylvania says there's no unlimited exemption, but if you're married, no one can touch your home if one of the spouses gets in a lawsuit. Yeah. So, anyway, there's about 13, 14 states that provide that.
Yeah. And tenancy by the entirety is a great one to do easy. It's just a way you get on the title, on the deed. And here's the one that we don't love as much. Let's say and this is where we get back to your individual situation. And we get this call quite a bit, or this scenario. One of the spouses is high risk. They're a plastic surgeon, a contractor, whatever. And they're like, man, if I get sued, I don't want them to get the equity in my home. Let me put the home in my spouse's name. And then I'm not on title. All right. And because I've got all the risk. And so if they sue me, I'm not on title to the property. My spouse owns it, my husband or wife, whatever the case may be. And so we don't love that. That's not great. What happens if you sell that house? Do you get the sell of home exemption for both of you for $500,000? You're married. You weren't on title. Your spouse was. I got all these issues with that, let alone what happens when they die.
Yeah, let alone divorce. And
we probably want it in a trust that's your joint trust anyways. It's just,
yeah.
So these other strategies, knowing your homestead exemption, tenancy by the entirety, are generally stuff we're going to gravitate to before putting it in one of the spouse's name because you think they're less risk.
Yeah, I love it, Matt. And, I put this as common roadblocks to protecting home equity. And I like that Matt brought up the sale of home exemption because you might do a technique and then you go to sell the home and the IRS is like, whoa, you didn't qualify for the sale of home exemption. Now you're paying tax on the sale of your home, which you normally wouldn't because you didn't think to have a strategy session. And this is, again, I'm sorry, this is not supposed to be an infomercial, but you may hate our firm. You just like our podcast. That's fine. But if you don't have a tax law firm that you can talk to once a year or twice a year on issues like this, one of the topics you want to bring up is protecting my home equity. What are we doing? How are we doing it? And one of the questions our attorneys are going to ask is, do you plan on selling the home soon? Do you have a revocable living trust? What state are you in? How much equity is in it? How many improvements do you put in? All these factors play into it. The one that I think is interesting, and this is where we butt heads with Dave Ramsey, is Dave Ramsey's going to say, pay off your home. Now, from an economic standpoint, I still struggle with that. I mean, yes, you've got your home paid for. So from a financial security standpoint, you don't have a house payment, you're done. But let's say your home's worth $250,000, just generally, let's say that could probably be a fairly medium home price around the country. That $250,000 is not making you money. It's just sitting there. Duh. Number two, it is a huge target in a lawsuit in a variety of states. Now, if you're in Texas and Dave Ramsey's saying pay off your home, okay, no lawsuit's going to touch that home. But if I'm in Arkansas and I pay off my home, I might have a problem. So paying off your home is a really precarious conversation.
Yeah, a lot of factors in there. I love that. There's an asset protection risk to it. But now again, maybe you're W-2 employee. You don't have a small business. You don't have rental properties. You don't have risks that can come at it. Or maybe you do, but you're like, all right, but I got the right entities planned. I've isolated where the risks are. I've got my LLC for my rental. So they're not going to be able to come down to my home. I've got the right insurance. I've got the right entity for my main business or side hustle to protect any liability that may be coming in there. So a lot of the asset protection planning can protect your home from them even getting down there. So it all comes together. It's all.
And I like how Matt mentioned insurance because we brought that up in level one because you may say, oh, I have an umbrella policy. I'm done. Go back and listen to level one. All right. Now we talked about homestead exemption, tenancy by the entirety. Now we start to broach using the home as our jumping off point to some of these more advanced strategies. So
but you want to talk about equity stripping at all?
That was next, number 3.
Oh,
Matt,
okay.
We just, good minds think alike. Why don't you explain equity stripping? I love that.
Okay. All right. Now this is not, for 21 and older. This is for all audiences. This strategy, okay?
Would you love to bring up the word stripping at any point in a conversation? But
yeah, this is equity stripping. All right, okay. And what we're talking about here is basically taking out the equity of your home and turning it into debt. The easiest would be a home equity line of credit on your house. Let's say you have a $500,000 home. You have $100,000 left in an original mortgage balance on. You got $400,000 of equity. You could get a home equity line of credit for at least $300,000, probably. That still leaves 20% of equity left, but you get $300,000 home equity line of credit. Now, the bank's going to put a lien on the property, generally, that says $300,000. They're going to lien it up to the maximum amount of the credit line that you have. Now, you may not even draw on that $300,000 line of credit, but you've got a lien on the property that makes it look like you've got another $300,000 of debt. Now, that makes that property not look very appetizing to a creditor if you get a judgment against you. They're not going to want to follow after your first mortgage and your second, and there's only $100,000 of equity left. By the time commissions and everything happens, there's nothing any lawyer's going to want to chase down. Mm-hmm. So the home equity line of credit with the bank, I like that one because it's legit. We could get a lien from a bank on the docs, looks nice and clean, and very, unattractive to a creditor that may be chasing you down.
And from there, it gets complicated. What happens if you don't pull on the equity line? You say, I want the equity line. Yeah. What's the cost? But I never drew on it. Now, if you're in discovery in a big lawsuit and you ran over someone's kid texting and driving, the lawyer's going to want to know, did you draw on that equity line? And when did you? Mm-hmm. So let's say you get in a car accident. You got the home equity line this week. Great idea, guys. You went and got your home equity line. Let's just think in a vacuum here. The bank moved quickly.
Yeah.
Oh, sorry, that was humorous. Okay, so you get your home equity. Whew, boy, that was a little hot flash there. Okay, so your home equity line gets done in a week, and you're on Mars, and then the week after that, heaven forbid, you get in a car accident. You're texting and driving, plow through a stop sign, boom, kill someone. The week after that, you now have a potential lawsuit, and you're nervous. They didn't file the lawsuit yet, but it could happen, and it probably will. Even though you've called your insurance company and you've called on your umbrella, everybody's waiting, see what's going to happen. So you go out and go, ooh, I better draw on that equity line. So you draw on the equity line after the cause of action has occurred, not the lawsuit, but the cause that created the action.
Yeah.
So now, I think a lawyer that's a good plaintiff lawyer is going to go, bullcrap. That was what they call a fraudulent transfer. You moved the money after the cause of action in an effort to hide it. So now that you're diving deep into a lawsuit to get to that point. No, but is the HELOC going to dissuade the average common litigator? Maybe. Smoke and mirrors. Another strategy we see people do. I have clients that set up entities in Wyoming where the ownership is completely disguised and the control. We'd use that as a privacy strategy. And that LLC of yours liens your home. There's no bank fees. There's no HELOC that really exists. But on paper, it looks like your home is mortgaged to the hilt. Smoke and mirrors. Would it survive discovery? Nope. Would it prevent your equity from going down in a lawsuit? Nope. But it might get some yahoo that's thinking of suing you to think twice. And it was totally affordable and cheap to do. That, my friends, variations on equity stripping. Lots of options.
Yeah. Love it. And there's no tipping involved or anything, so. All right. Okay.
Number 4.
Oh, you got another one still on the home?
Oh, yeah. I got 5, 6. Okay.
Dang.
No, number
Fire
4.
away.
Now, this is in my book, and this is just dedicated protecting your home in a lawsuit, chapter 19, tax and legal playbook. Easy to read, some good examples. Number 4 is the DAPT, which opens the door to that conversation. Number 4. Do you want to explain this?
Yeah.
Kick it off, Matt.
Yeah, the DAPT. This is the Domestic Asset Protection Trust. This is a pretty good trust, actually. We like this trust for clients in states that have a DAPT statute.
I'll read them off here when you're
Nevada's
ready.
got one. All right, Utah's got one. I don't know, what are the rest?
I'll read them off. Keep explaining while I pull it up.
Okay, all right. The DAPT, what it basically is it's a trust. Think of it like your trust for estate planning purposes, but we're going to put assets in it that we want to have asset protection for. For example, your home with a ton of equity. Now, these types of trusts are protected from creditors. Very different than your regular revocable living trust that we're going to do for estate planning. The DAPs are cool because they're protected from creditors. So if you get in a lawsuit situation, I remember we had a client once, a Nevada client with a Nevada DAP, $600,000 judgment against him. Their bank accounts at Wells Fargo were owned by their DAP. Creditor sent in a seizure to go get that cash. The bank was this close to releasing that money to the creditor and realized it was a domestic asset protection trust protected under Nevada law and was like, nope, you ain't getting it. Sorry. And that client was like, oh my gosh, saved me, you know?
It was
and
so exciting. That was a neat day.
Yeah. So that was a good one. That was a good sign of like, all right, that worked. And so that's what the DAP is, but you can use it for your home. You can put your home in it. Now, if you're in California and you got a house in California that's your home and you're actually trying to protect, you're not able to do the Nevada DAP. That protection has been, I don't know how challenged it's been in the courts, but don't think of it for out-of-state assets.
Well,
we
let me
like
say,
it for like
let me say that client, remember that client, that example you gave was in California. Now it was a
they
bank
moved
account.
to Nevada. No. They moved to Nevada. They were a Nevada resident.
Oh, he had already moved to Nevada. Okay.
Yeah.
Now, but here's what I want to say is kind of on that smoke and mirror strategy. If you're in California and you got the California 401k, which is $1 million of equity in your home, what do you do? There is no homestead exemption. There's no tenancy by the entirety. Putting it in an LLC is worthless. You get all the insurance you can. Throwing it in a DAP is smoke and mirrors. We're not saying it's going to win at the end of the day, but it definitely is going to create hurdles and persuade settlement and things like that, which is what asset protection is about, is encouraging settlement and making more barriers and it difficult to get sued. So, but I like what Matt said, that depending on the type of asset and where you live, it's going to help us determine where to set up the DAP. Ideally, you want the DAP. You want to be in a state where DAPs are recognized, legitimate, the assets in that state, you sign it, you put it in there, done. The end. But that's not always going to be the case. The stars are not always going to align. And so you can look at options, and I think that's okay. I think it creates barriers.
And there's a lot of people use it in other states. I'm just, that where you might have multiple assets in multiple states, even real property that's physically in another state. So there's just a little state issue there just in terms of when to use it. But the nice other thing about the DAP is, again, your regular revocable living trust is not asset protection. You have assets in that, they can blow right through it. We're doing that for estate planning. The DAP has this asset protection where a creditor just cannot get at those assets. You got a judgment against you. They're not able to get into the assets in the DAP. Now, the nice thing about the DAP is you do not have to do a trust tax return. There's some irrevocability to it, but it's not one where you have to file a trust tax return. Everything is allowed to flow down to your 1040 onto your personal tax return. So your tax reporting is actually pretty simplified too with the DAP, where some of the other trust structures that you might do, super tax nightmares, increased tax rates, more tax reporting than you would generally want to do. So the DAP's a little streamlined and easy for tax reporting.
Yeah. Let me give you the states. We could do a whole show on DAPs. In fact, I think we have in the past. Here's the 18 states. Oh my gosh, I'll read them quickly. Alaska, Delaware, Hawaii, Michigan, Mississippi, Missouri, Nevada, New Hampshire, Ohio, Oklahoma, Rhode Island, South Carolina, South Dakota, Tennessee, Utah, Virginia, West Virginia, and Wyoming. Now, the states with the strongest DAPs are Nevada, South Dakota, Utah, Alaska, and Delaware. And so if you're gonna choose a forum in a situation, you're gonna want to go to one of those more stronger DAP states. Anyway, great strategy, and we really don't recommend it for anything other than maybe your home or some liquid assets, like some
investment account.
Yeah, investment account, bank account. You don't want to be putting your businesses in these DAPs. It's too cumbersome. Okay, now number 5 and 6 we've already talked about but in the book I talked about putting it in your spouse's name, the home, which we said is very precarious, and then number 6 was umbrella insurance. So there's a variety of things you can do for your home, and after that point, I'm going to just say this, Matt, and throw it your way. you've done level one, you've done level two, you've got the right entities, you've isolated the risk in your rentals, your business, you've got the right insurance. We talked about so many little nuances to good asset protection, maintaining your entities. You've got your retirement accounts under control. You know where they're at, what state you're in, how they're protected. And then you did look at your home. You looked at your home equity. Do I have my revocable trust? How is my home equity exposed? How much is exposed? What am I doing to protect it? Then we go next level. Maybe there are some bigger assets and that need a little more love, a little more protection. Mm-hmm. What comes to mind for you?
Well, I did want to circle out on the trust stuff just because we brought up DApps. I want to talk about some other trusts.
That's good. Okay. Some of these irrevocable trusts.
Yeah. So some clients get really sold on an irrevocable trust, and it's in the Bahamas or the Cook Islands, or it's one of these jurisdictions where they're called self-settled trusts, but they're one of these foreign offshore. Let's just call it offshore trusts. Okay. It's on the Isle of Man or whatever. Okay. These offshore trusts that have kind of became asset protection havens. They really have. People have gone there to put assets to try and keep them away from creditors. And just a word of caution on those. That is not a standard strategy we recommend for clients. The average small business owner, real estate investor should not be going down that path. Even if you got tens of millions of assets, I don't know that I would do that strategy. It could be very risky, and there becomes some major baggage. The number one area of baggage on an offshore trust, the IRS. They got 80,000 new agents enlisted. And when you have a offshore trust, you got to start doing offshore asset reporting. You got to start throwing that on your tax return. You want to talk about a big red flag for the IRS? Offshore.
Yeah. I think it's a great point. And there are firms that are going to recommend some irrevocable trusts onshore. Nevada tends to be these constitutional type trusts or Commonwealth trusts or business trusts, and they'll call them all sorts of names to make them sound so sexy. And I have clients inevitably that come back and go, oh my gosh, the tax reporting, they were so much work. They charged me $20,000. They charged me this, that, and another. And get a second opinion before you go down one of these irrevocable trust rabbit holes. Now, do they work? Absolutely. Not saying they don't, but they come with a lot of strings, and you just want to understand what those are, and be careful. I think people that listen to our podcast too have kind of figured out our lane. I want to be, I'll say it and be honest, is that I'm not planning assets for $20, $30 million clients every day. That's not what I do. That's not my lane. There's trusts I'm sure I've never even heard of that the 50 million plus Uber's rich people use. But they can go to White & Case and those big law firms and get some specialized treatment. I'm there for the Main Street American. That's the name of our podcast, Main Street America. If you're really worth 20 million or more, we may even suggest you get a second opinion or consult with one of these expensive big law firms. And buckle up. Go in with your checkbook. That's all we're saying.
Yeah, but here's the one thing on these irrevocable trusts and offshore trusts. They're not doing it for the 50 million clients either. More of those trusts are owned by people that get sold them. And so unique scenarios where people do them, just be careful. And I do love the comment on get a second opinion on it, because most lawyers are going to be like, you don't need that. You're wasting your money. Let's do this instead. It's easier. It's cheaper. Better solution for you. Doesn't wreck your tax reporting.
One thing that, Matt, we kind of like, we did a crypto asset protection webinar this past summer, and we had some foreign asset protection folks come in and talk.
Yep.
And I thought they were quite reasonable. They made they're expensive.
They didn't oversell it. They're like, here's what it does. It's not like, this miracle pill or something that's like going to solve all your problems.
Yeah.
And I thought that was a fair way how they approached it.
Okay. Now, which means, in our last 6 minutes, we're going to bring up probably now we've saved the grand finale for what I think is probably the most common next level asset protection. It's domestic and foreign. and it's called the COPE, the Charging Order Protection Entity. And the COPE is where you've probably heard, I need to go to Wyoming, or I need to go to Nevada, or I need to go to Delaware to protect my asset. Now, the best way to explain a COPE is this. Let's go back to my example earlier in the show where, heaven forbid, you're texting and driving and really hurt someone. That liability occurred to you personally, and they're going to go after everything you own. And then let's compare that to, you have a rental property and a tenant falls down the stairs and gets hurt. They're going to sue the LLC and get anything the LLC owns. But the LLC is there to protect you. See, that your LLC protects you from the operations inside your business. But when you get in that accident on the street, they're going to sue you, and that's a liability outside of your business. So a lot of people, in summary, and I'm just going to get this general point out, then Matt, you can unpack it more here, I'm sure you more efficiently than me, is that people say, oh, I set up an LLC, my rental's protected. No, it's not. The LLC didn't protect the rental. The LLC protected you from the rental property.
Yeah.
So what do you mean? I got in a car accident. My rental's protected. No, in a lot of states they can get into the LLC and take your rental. The LLC protected you from the rental, your home equity, your personal assets from the rental. It's not a two-way street in every state. So notice how I pulled in accident, street, two-way. You like that?
Yeah, I like that. That was good. That was
close.
good. Yeah.
Okay.
And staying in your lane and all that.
Yeah,
Like, and, I
working
like
it.
that.
A little Fast and the Furious.
Yeah, just a little Vin Diesel over there.
Throwing down.
Or what was the guy? He died. What was his name? Paul
Walker.
Paul Walker. He probably, you know what I mean? Paul Walker.
And died in a car accident. Isn't life ironic?
Oh, he died in a car accident?
He was driving a Porsche and wrapped it around a tree.
That sucks.
Isn't life ironic? It's just...
Dang it.
Yeah.
That's a buzzkill. Sorry, guys, bringing that up.
Okay.
All right. Back to charge.
Okay, so COPE.
So COPE, let me just say what we like about it. We like that you can use a COPE entity in a state like Wyoming. That's generally the state we love for COPE. And what we'll do is we'll have you own the COPE. The COPE owns your property entities, the LLC. Let's say the LLC in Arizona that then owns the Arizona rentals or rental. So it's a middle company here. Sometimes we call it the holding company or charging order protection entity here in the middle that then owns a property LLC that owns the property. Now I'm protected both ways. Something happens at the property level where they're stuck at that property level LLC. That Arizona LLC that owns that Arizona rental, the Arizona tenant that slept and fell, they're stuck at the Arizona LLC. So I'm protected from them coming down to me. But now I also get in the car accident on I-10 in Phoenix and I get a judgment against me personally. Well, I don't want all that equity in my property at risk. They're gonna have to go upstream. What do I own? I don't own an Arizona LLC. I don't own an Arizona rental. I own a Wyoming LLC that owns an Arizona LLC that owns a rental. They got to work their way up. Yeah. Now, as they're coming up, they get stuck at this Wyoming LLC because Wyoming law says, "Hey, charging order protection. If there's a single owner of this LLC, a creditor stays outside of it. They can't get into the assets of it. Yeah. They're stuck."
I love it. Now let's explain the word. One thing I'm embarrassed here. I just realized we've never explained what charging order functionally means. So let's say you're in that car accident through the crosswalk, texting and driving, and they file the lawsuit for $1 million. And you've got that structure Matt just talked about. You're in Arizona. You own a Wyoming LLC that owns your Arizona LLC. So we've got this extra layer in there. You're willing to pay for it. It works for you. And we're not doing this for every client. We're going to look at the amount of properties you have and the equity and all those goodies. And you can actually get these COPEs going for $1,000 and maintain them for $200 to $400 a year. They're not terribly expensive. I think umbrella insurance could even be more. But anyway, you get in that lawsuit and they get a judgment against you. They actually win the lawsuit. They found out you were texting and driving, $1 million judgment. They're dying to get into that rental property. Well, the judge issues an order, and he charges the parties with this. He says, I'm going to give you a charge with this order that you can have any money that comes out of that LLC, but you can't get in it. You can't foreclose on the property. You can't lien the property. You can't force the sale of that property. But if Matt Sorensen decides to issue a dividend, for lack of a better word, or issue some income from the LLC in Wyoming, then you get to have it. So I'm going to order Matt. Here's my charge, Matt. If you issue any money, it's got to go to these people. Well, what's Matt going to do? Is he ever going to take out any money? Nope. And so the plaintiff is stuck. They're going to go, damn, I have a judgment in this charging order that's been given, and I can't get that money. And so they say, I'll settle. And it forces settlement because they know they're going to sit around forever and wait, and they don't want to. They want money now. Money now is better than money later. So that's how that charging order works. And Matt, you just alluded to it. We don't set this up for everybody.
Yeah. Yeah, if you're a brand new investor buying your first rental or two, we're not doing this, okay? No. If you got $1 million or more in equity worth protecting amongst your rentals or other assets you want to use this COPE for, let's talk about it. I'm not even sold that we're going to automatically do it. Let's talk about it. Let's see what risks you have, and then but the cost isn't significant. This is not like these offshore trusts that's $15,000 to set up and then $10,000 a year to maintain. It's much more affordable. It's a great solution to protect your assets from your personal liabilities. That's what the COPE's all about.
I love it. Well, everybody, hopefully you've been able to take away a little golden nugget here of something that might work for you and your plan. Thank you for participating in this 3-part series. You, at the very least, have hopefully been prompted to have an asset protection review with someone you trust, a lawyer, please, wherever you may find that trusted lawyer. We're here for you at kkoslawyers.com. If you'd like to have that consult, all of our lawyers know this information backwards and forwards. It can be very affordable. Go through the 3 levels again. Listen to them with your partner, your spouse, your kids, whoever, and make sure you're on the same page on the level of protection you want to do. You may be shocked that we did not talk about privacy. That's a different topic. Hiding your assets is different than protecting them. We've done prior podcasts on that. We're planning to do another one soon. But thanks, everybody. And Matt, any final words?
Yeah, thanks for being here. If you liked this 3-part episode, let us know. Subscribe to the podcast. Give us thumbs up, 5 stars, all that stuff. And we'll be back, of course, next week, trying to blow your brains with something awesome that'll affect you, the Main Street business owner.
See you next week.